Welcome to The Explainer. Today, we're going to break down two of the most powerful tools in modern finance, exchange-traded funds and their close cousin, commodity funds. We're going to see how these things didn't just tweak the rules, they completely changed the game for everyone.
Okay, so let's just jump right in with a question. What if you could buy a little piece of the entire stock market with just a single click? I mean, it sounds simple enough, right? But for decades, this was a massive, super complicated problem for the average person trying to invest their money.
See, back in the day, if you wanted what experts call a diversified portfolio, you had to go out and buy shares in dozens, maybe even hundreds of different companies, one by one. This took a serious amount of cash just to pay for all the trading fees, not to mention a mountain of research and constant effort to manage. It was a huge barrier that just kept most people on the sidelines.
But then, something came along that combined the best of two different worlds and completely changed the landscape for investors. This was the arrival of the exchange-traded fund, or as we all know it, the ETF.
So what on earth is an ETF? Well, the easiest way to think about it is like a shopping basket. But instead of groceries, it holds a whole collection of assets, like, say, stocks from every single company in the FTSE 100. But here's the really clever part. You can buy or sell that entire basket on a stock exchange all day long, just like you would a single share of a company.
And this comparison right here, this really gets to the heart of the ETF revolution. Just look at the differences in trading. Old-school mutual funds only get priced once a day after the market closes. ETFs, on the other hand, trade live. This gives you real-time pricing and lets you react to the market instantly. On top of that, they're usually way cheaper, and they're way more transparent about what's actually inside the basket.
So the crucial thing to get here is how all these features add up. ETFs can track almost any market index you can possibly think of. They have super low fees, and they're incredibly easy to trade with what we call tight bid-offer spreads, which really just means the gap between the buying price and the selling price is tiny. It all comes together to give every investor a level of flexibility and cost efficiency that was pretty much unimaginable before.
Okay, so that all sounds pretty great, right? But how does an ETF actually pull this off? How does it manage to follow an entire market index so closely? Let's pull back the curtain and take a look at the engine room.
The real magic trick behind an ETF is in how it replicates or, copies the performance of whatever index it's trying to track. The company that creates the ETF has to build a portfolio that moves in perfect lockstep with that benchmark, and they've got a few different ways to do it.
This table here kind of lays out the playbook, and for the fund managers, each one is a balancing act. With full replication, they literally buy every single stock in the index. It's super accurate, but it can get expensive. So to cut costs, they might use sampling or computer models to build a portfolio that just acts like the index. A little less precise, but cheaper. And then you've got the synthetic method, which uses financial contracts called derivatives. It's often very cheap and precise, but it does introduce a different kind of risk called counterparty risk, which is just the tiny chance the other side of the deal can't pay up.
No matter which method they use, nothing's ever perfect. There's always going to be a tiny little gap between the fund's return and the index's return. This is called tracking error, and it's just the result of real-world costs, like management fees. The name of the game is to keep that error as small as humanly possible.
All right, let's switch gears a bit and tackle the next challenge. ETFs are absolutely fantastic for things like stocks and bonds. But what if you want to invest in physical things? In actual real-world stuff?
And this brings us to commodities. For the longest time, if you wanted to invest in something like gold or crude oil, you had a bit of a problem. I mean, you can't exactly buy a barrel of oil and stash it in your garage, right? The typical workaround was to just buy shares in a mining company or a big oil producer.
But see, that was never really a pure play, was it? The price of a company's stock is affected by all sorts of things. How good the management is, what their profits look like, what the market thinks about them, not just the price of gold or oil. Your investment wasn't a direct bet on the commodity, it was really a bet on a specific company.
And this is where the solution comes in. The Exchange-Traded Commodity, or ETC for short. It's a tool that was built specifically to give investors direct exposure to commodity prices, and it strips away all that company-specific risk.
And what's cool is that, just like ETFs, you've got options. You can use an ETC to target one single commodity if you have a strong opinion on, say, the price of silver. Or you can buy a broad commodity index ETC and get a piece of the entire commodities market all in one shot.
And if you're looking at this list and thinking, hey, this sounds really familiar, you're absolutely right. ATCs are running the exact same playbook that made ETFs so successful. They trade on an exchange,
New shares get created when people want them, and they're just as easy to buy, hold, and sell as any regular stock. It's a proven, efficient, and super accessible system.
Okay, so we've looked at ETFs, we've looked at ETCs. What's the big picture here? Why does any of this really matter to you as an investor?
You know, when you boil it all down, what these tools have done is pretty profound. They've essentially democratized investing. They've torn down old barriers and given absolutely everyone the ability to build sophisticated global portfolios, accessing parts of the market that used to be just for the big institutional players.
It really comes down to these three huge benefits. First, you get unprecedented access to markets all over the world. Second, you get incredible liquidity and flexibility, the power to trade whenever the market's open. And third, and this is a big one, a structure that just dramatically slashes the cost of investing.
This quote here really nails it. These things aren't just slightly better versions of old funds, they are a fundamental evolution, merging the wide-ranging diversification of a fund with the simple, clean efficiency of a single stock. It's truly a paradigm shift in how we can all think about building wealth.
So, we've seen just how much ETFs and ETCs have revolutionized investing. They offer this powerful, efficient, and incredibly flexible toolkit. The real question this leaves us with isn't whether these tools are useful anymore, but rather how you might use them to build a strategy that's right for you.